So in this video, we're going to peruse over just one of so many comical articles that I find on the so-called business news website called Market Watch, which apparently allows anyone who is a financial professional, even if they're licensed insurance agents, to volunteer articles giving retirement advice. And then they call these guys retire mentors. Mentors, imagine that. But if you read just about any one of these articles about annuities on this website, you will discover that they are nothing more than thinly veiled advertisements for annuities, which reinforce misconceptions about the markets, reinforce the same old lies about annuities, which I talk about in my videos. They use the same old straw man arguments, shell games, and of course they use anecdotes rather than contract data. They want to control and mold people's perceptions about annuities, and they want you to think that annuities are a bread and butter part of your portfolio. So here's this damage control article called 3 Reasons Why Critics Tell You Not to Buy Annuities. And this guy starts out by basically saying that baby boomers don't have enough money to retire. Well, guess what? If you don't have enough money, you don't have enough money. And you can't get blood out of a stone because insurance companies are not playing Santa Claus. So we're back to square one. You don't have enough money. Then he makes a statement of opinion that people should consider other options besides stocks and bonds. Well, how convenient. And then he presents the number one straw man argument that insurance salesmen use. He talks about the markets having way too many fluctuations for the markets to work. And this is total hogwash. And he suggests that because interest rates are low, that somehow annuities are going to provide better returns. And if you think this is true, then you need to watch this video. It's nonsense because insurance companies invest heavily in bonds, 70 to 94% in bonds. So if what he's saying is true, that bonds are going to provide lower future returns, then insurance companies can't promise anything better or they'd go out of business. And then here he goes with that buzzword, guaranteed lifetime income, which I've covered time after time in my videos. These guys never say the word adequate income, because eventually annuities leave you in poverty. Then he uses the old, annuities should not be considered growth products. They're steady lifetime income products. Yeah, well, the problem is that the way these products are designed is that you don't even get decent income if you live long enough. They tease you with a higher rate of income that eventually gets surpassed by a low-risk portfolio of stock and bond index funds. And then when you die, because they're not growth products, your heirs get too little or nothing. And then he's using that word, transfer of risk. What risk? Where is the great risk? What is he talking about? And then he talks about immediate annuities as if it's a positive that if you die before your income base is paid out, the remainder of what has not been paid out goes to your beneficiaries, for example, under a single life with cash refund policy. The problem is that the growth of your income base stops once you turn on the income stream. That's nothing to boast about. I mean, imagine if the stock and bond markets got stuck at their current level once you started retirement. That's a bad thing. Then you spend that money down until there's zero left, and that's how a SPIA works. Beneficiaries get zero return on investment, no matter how long you live. And then so this comment is hilarious. Some financial advisors view the loss of control of your money with annuities as a negative. Yeah, there's a million reasons why people might need to get their money back, and there is no way for an insurance salesman to predict whether this might happen. And if you don't need to lock your money in prison, why would you take on that liquidity risk? And so what do you get in return for locking your money in prison in an annuity? Income payments. Whoop-de-doo! I can get the same exact thing with a low-risk mix of bond and stock index funds. Oh, but it's not guaranteed. It doesn't need to be. I can make reasonable assumptions based on the long history of the markets, including 2008, including 1966, including the Great Depression. Again, I'm not investing 100% in stocks if money is tight and I'm retiring. But yet this guy is still talking about safeguarding you from market changes. And he's carrying on about substantial drops in the market that can decimate the chances of your portfolio lasting 30 years. Straw man argument. And then notice how he glosses over how there are some ways to deal with risk by incorporating more fixed income assets. You don't say. Yeah, that's the solution right there, but yet he only spends 2 seconds glossing over it because his goal in this article is to puff up annuities because they pay agents who sell them huge commissions. Then this next paragraph is also hilarious. He's talking about how annuities are only backed by one single insurance company. They're not FDIC insured. And what is his solution? Just pick a company with a strong, credible, and solid financial rating and you'll be okay. I mean, this guy is a comedian. I mean, remember AIG? Remember Executive Life Insurance Company? Both large and reputable companies. What this guy never talks about is that if an insurance company becomes insolvent and it's up to the state guarantee fund to bail you out, they only pay up to a certain dollar amount. And in California, they only pay 80% up to that dollar amount. And if there's a systemic failure of insurance companies, that bailout fund may become depleted. And by the way, nobody has ever lost a dime of FDIC insured deposits. So then he goes on talking about if you're putting money away for short-term purposes, an annuity is not right for you. But again, with long-term purposes, nobody can predict if they might need to get their money back, especially 10, 20, or 30 years from now. Insurance salesmen have no business telling people that they're not going to need their money 10, 20, or 30 years from now. So then he says, annuities aren't the most perfect solution to ensure financial success. I mean, talk about putting lipstick on a pig. My God, most perfect solution. And then here he goes with a statement of opinion that part of being diversified is to have a mix of liquid investments along with illiquid investments. Utter nonsense. You don't have to put any of your money in long-term investments, and you shouldn't because of the liquidity risk. And have you noticed that long-term investments don't even give you better returns? They're inferior returns. It's commission-hungry salesmen who are always trying to push these long-term products, and in the meantime, they're making huge sales commissions that reduce your returns. This article is nothing more than a one-sided advertisement, a thinly veiled advertisement for annuities.